Kicking off the day's equity and bond market session and wooing for a better day than yesterday's market plunge, that was before getting down to the serious business of discussing funding climate change mitigation and adaptation. The Presidential Climate Commission shared its detailed Just Transition framework with the financial sector, which looks at how the country will need to shift its economic activities to work towards the country reaching net zero emissions by 2050. The financial sector is an important stakeholder as it will be required to help finance this transition.
The cross-cutting and fundamental nature of the challenge demands that there is a close cooperation between the public and the private sectors, as Leila has also just said now. This is a shared challenge, and we need to collaborate closely and quickly to find tangible and workable ways to effectively finance the transition.
The financial sector has already begun to look at investing and funding sustainable businesses and projects, with a number of commercial banks already ruling out funding any further new coal-related projects, for example. And the JSE has been instrumental in cultivating this type of investment by introducing investment products like green and transition bonds, as well as ESG.
If we are to be successful in the long term, a clear transition framework is crucial in aiding the capital formation and capital flows that support the transition to fund climate mitigation and adaptation initiatives. Funding a just transition to a net zero carbon economy will be the greatest public-private partnership that this country has ever seen.
South Africa has been offered funding of $8.5 billion from the United States, the United Kingdom and the EU in order for the country to become less dependent on coal. While the PCC is still working on the terms and conditions attached to those funds, it's hoping that this starter amount will also help to crowd in private sector investment. And it's quite mindful that any monies received from overseas do not become burdensome from a high-interest foreign-denominated debt perspective for generations to come.
Any financing package we develop and negotiate should reflect South Africa's unique fiscal challenges and incorporate an equitable risk-sharing arrangements, and this will be achieved through a combination of grants, concessionary finance, risk mitigation instruments, and other appropriate tools that contribute towards the costs of the transition without inhibiting or negatively impacting the country's national borrowing programs and budgets unduly.
The just transition will involve the reduction in the use of coal, which the country has in ample supply and is currently heavily dependent on. And while there's a strong focus that workers and communities are not adversely affected by the process, there are concerns about the economic pain this will inflict in the meantime.
Transitioning or moving towards net zero implies low economic growth because we'd have to use less energy. Now, how do we deal with the social issues in the context of wanting to move towards net zero at the same time reducing our social issues? So I think those are that is the complexity of what we have to deal with in the country.
But it seems that the country has little choice but to proceed with the just transition process. Already, we've seen the local impacts of climate change in KZN and elsewhere on the continent. And trade patterns are set to change as import-receiving regions like the EU are set to impose penalties on goods that have a carbon footprint as soon as 2023, which would make some exporters uncompetitive on the global stage. Nompumelelo Siziba, SABC News, Johannesburg.